Hi, this is Keith Hall. Welcome to Economics 590, the federal budget process. This video is going to be on financing government, or in other words, how does government pay for its spending? So happens in 2020, it was a real mix of total spending of about $6.6 trillion. About 52% of it was paid for by revenue, and 48%, or over $3 trillion of it, was paid for by borrowing. Well, let's start our talk about financing the government by looking at types of taxes. We have, for the federal government, we have individual income taxes, payroll taxes, corporate profit taxes, taxes on excise on purchases of goods and services, and state taxes. Individual income tax is levied on wages, salaries, dividends, interest, and other income a person earns throughout the year. The payroll tax is collected to finance Social Security, Medicare, and unemployment benefits, and that's deducted from paychecks directly. Corporate income taxes are paid on corporate profits, and most corporate income is taxed at 21% in the United States. Excise taxes are indirect taxes on goods and services. So this would be taxes on purchases of things like gasoline, alcohol, or gambling. And then estate taxes are paid on estates, and it's paid on any estate above 11.18 million and gifts above 15,000. Look at the revenue from these different types of taxes. We can see a little diagram here and see that by far the most important is revenue from individual income taxes. That pays for about 50% of total revenues. I'm looking at 2019 here because 2020 was such an unusual year. 2019 was a more normal year. Payroll taxes were about 36%. Corporate income taxes were about 7% of total federal revenues. Excise taxes are 3%. And then there are other taxes. Here's what the types of taxes look like over time. You see that the individual income taxes here in this chart looks at taxes as a percent of gross domestic product from 2000 till now. You can see individual income taxes varies a lot. It's cyclical. When we go into a recession here, go into a recession there, individual income taxes go down because income goes down. And it varies a lot. And then, of course, we had the 2017 Tax Act that changed individual income taxes. We had the American Taxpayer Relief Act of 2012, etc. But you see individual income taxes are consistently the most important taxes. Payroll taxes continue to be important. They go through a cycle as well. Corporate income taxes are much less important. You'll see in particular that there are changes in the tax law. For example, in 2003, 2007, that affected corporate income taxes. So if we look at just federal payroll taxes, most of that goes to Social Security. Some of it goes to Medicare. The rest goes to other things. In the U.S., we have primarily an income-based tax system. Other countries have different base systems, in which case a specific tax rate is applied to taxable income. And it's taxable income for individuals, corporations, estates, and trusts, private trusts. And income is typically divided into ordinary income and capital gains income. Ordinary income is just taxed regularly on an annual basis. Capital gains income is a tax on ownership of capital, but it's taxed only when gains are realized, when capital is sold, and it's taxed at a lower tax rate than ordinary income. We want to make a distinction here between the statutory tax rate, which is the rate imposed by law on taxable income that falls within a given tax bracket. Then we have the effective tax rate, and it's the percentage of taxable income actually paid as a share of income of taxable income. So the effective tax rate takes into account tax loopholes, tax deductions, tax exemptions, tax credits, and other preferential rates. We get an idea here of how progressive a tax system we have. In the United States, again, this is a snapshot for 2019. You notice that the top 20%, the top quintile of households that make more than $163,000 a year, they earned about 53% of total pre-tax income and then pay 68% of the taxes. So their tax payment is above their earnings. And then for everybody else, it's the other way around. For the fourth quintile, between $91,000 and $163,000, they pay 18%, even though they earn 21%. For the middle quintile, they earn 14%, pay 10%. For the second quintile, they earn 8, pay 3. And for the bottom quintile, the bottom 20%, they earn about 4% of income and pay about 1% of taxes. Next, we have tax expenditures. They're also sometimes called tax subsidies. This is where the tax code offers preferences for either individuals or types of individuals or businesses or types of businesses or types of income. There are tax exclusions, exemptions, deductions, and credits. They're all part of tax expenditures. For tax exclusions, it's where certain categories of income are untaxed. So one example is families in active duty military. The military pay the pay they received in a combat zone is untaxed. Tax exemptions are shield certain assets from taxation rather than certain income sources. And that would shield something like if you own a state or local bond, the interest you pay on that bond is exempt from taxes. If you contribute to charitable organizations, that can be exempt from taxes. There are tax deductions, which allow you to deduct expenses from taxable income. One of the important ones is medical expenses. So if you have high medical expenses one year, your expenses are above 7.5% of your income, then the expenses above that amount are deductible. Then there are tax credits. Tax credits reduce taxable income. And in fact, if tax credits are applied to low levels of income, then of course taxes can be driven to zero. But for some tax credits, they're refundable, meaning if your income's so low, rather than paying taxes, you in fact can get money back from the government. So tax credits that are refundable are really subsidies. We have two types of tax expenditures. We have those on individual income. We have some on corporate tax income. The largest individual income tax expenditures are listed here. The one is the employer-provided health insurance. So if you get health insurance through your employer, probably most of you do, then what you pay in health insurance is exempt from taxes. If you own some capital and you have a capital gains, then that's taxed at a particular rate, a lower rate for capital gains than for ordinary income. The logic here, of course, is that paying taxes on capital gains is a second tax. You've already paid your income tax, then you have capital gains earned on top of that. You're now getting a second tax on that income that you earned earlier. Third tax expenditure is owner-occupied housing. Good example of that is the mortgage interest deduction. So if you own your own house, then whatever you pay in mortgage interest every year is exempt from taxes. And then the employer-based retirement plans are treated special. So if you have a 401k or something through your employer, that gets preferential tax treatment. For corporations, for multinational U.S. corporations, if they earn foreign income, that's taxed at a lower rate than if it had been income from domestic profits. And there is accelerated depreciation for machinery and equipment corporations. Tax expenditures are very costly. They're very large in the United States. If you look at some of the largest programs, for example, Medicare and Medicaid combined cost taxpayers about $1.1 trillion a year. At least they did in 2019. Social Security costs about $1 trillion a year. All of defense spending is about $700 billion a year. All of non-defense discretionary spending is about $700 billion. But if you look at tax expenditures, that's bigger than any of these. That's $1.3 trillion in spending on tax expenditures, most of it for individuals, a smaller amount for corporations. And tax expenditures skew towards higher levels of income. Of course, since it's giving you a tax break, those with the higher levels of income pay higher taxes, so they get more preferential treatment when they have a tax expenditure. So you see, for example, 4.3% of tax expenditures benefit the bottom fifth of income earners in the United States. About 60% benefit the top fifth of income earners. And the top 1% get about 24% of tax expenditures. So at a glance, kind of in summary, total revenue collected by the federal government in 2020 was $3.4 trillion. Of that $3.4 trillion, $1.6 trillion is from individual income taxes. That's the biggest single source of revenue. That $3.4 trillion is about 16.3% of GDP, down a little bit from 2019. Total revenues averaged over the last couple of years at 16.8% of GDP. Then we also have federal borrowing. Government borrows to fund their spending. First, let's look at something called federal debt held by the public. So federal debt is the accumulated borrowing over the years, over the decades, by the federal government that has yet to be repaid. And this is the portion that's held by the public. In other words, it's mainly debt that's held as Treasury securities. And these securities were issued by Treasury to raise cash to fund the operations of the federal government. And it's held by the public, so it's held by outside investors, also held by the Federal Reserve. The debt service on the federal debt is the payment of scheduled interest obligations on outstanding debt. So, of course, for old debt, that's had a tremendous amount of debt service. Decades and decades. Some of the newer stuff continues to have debt service on it, but until the debt's paid back, we'll continue to have debt service. And federal debt held by the public does not include intragovernmental holdings of debt. So in other words, sometimes rather than issuing debt to the public, debt is issued to other federal parts of the federal government. So you have one part of government borrowing from another part of the government. That in particular happens in federal trust funds. So when the federal government collects revenue to put into the trust fund. They don't hold it in the trust fund. It gets loaned out to some other part of the government. As of April 2021, the total U.S. national debt was $28.1 trillion. Of that 28.1, 78% of it, it was held by the public, and 22% of it was held by other government accounts. And by far, the government account holding the most is the Social Security Trust Fund. Let's look at the public holdings of U.S. Treasury securities in a little more detail. Again, the holdings by the public are something around $22 trillion. And one thing that's happened is foreign holdings of treasuries have ballooned in the past decade. So of that 22 trillion, 7 trillion is held by foreign institutions right here and right here. Pension funds hold some. State and local governments hold some right here. The Federal Reserve holds some. Insurance companies, banking, mutual funds hold a lot. Then individuals hold some. And so we have the question, why do investors buy federal debt? First, it's backed by the full faith and credit of the U.S. government. We'll see at some point having the government default on debt might shake this faith in the credit, in the credit worthiness of the federal government. Federal debt's held in a wide range of maturities. It's exempt from state and local taxes. It's mostly marketable. So in other words, when you buy it, you can resell it. You can buy it from other people. It's bought and sold in the financial markets. So investors can easily trade Treasury securities. And investors are willing to pay more for federal government debt than other debt typically, because government debt is viewed as being safer and more liquid. It's easy to trade, buy and sell. Everybody will buy it typically. It's easy to sell. So part of what this means is the borrowing cost for the government is pretty low. So they don't have to offer a very high interest rate. So if the federal government were to have a financial crisis of some sort that shaked people's confidence in the federal government to pay back its debt, it might raise interest rates that's paid on federal debt. It could have a pretty significant future impact on the cost of debt. And managing this debt is challenging for Treasury. Treasury is constantly managing the debt. They're trying to ensure that there's enough money to run the federal government. They're trying to do it in a way that it has the lowest cost possible. And their challenges are that the financial markets are constantly changing. So they're constantly having to manage the debt. There's some uncertainty in future borrowing needs. There's some uncertainty about the debt limit. Congress has at times, and there currently is a debt limit on. And the question is, will Congress hold tight on the debt limit and not let Treasury issue some more debt than it needs to pay the bills? And they're constantly having to refinance debt. Money they borrowed years ago comes due, and they'll need to borrow again to pay off the older debt. So it's a constant churn. And the federal deficits and surpluses, we've averaged significant deficits year after year after year. The deficit in 2020 was 14.9% of GDP. It's the highest ever, which means it was about 3.3% on average over the past 50 years. And the accumulated debt's about 100% of GDP, is about as big as GDP is. Here's what the accumulated debt looks like. Here's what it looked like right after World War II. That was the record at something like 104%, something like that. We're there now. The debt, while it fell after World War II, it's continued to rise and really risen in recent years. This part to me is very concerning because this is the effects of the Great Recession. And then we had a nice recovery and GDP growth was pretty strong, and we continued to accumulate debt. And under current law, spending is going to continue to outstrip revenues. We'll talk about more about that soon. But here's a projection of what total debt's going to look like over the next 50 years. To put some things in perspective here, here's what debt looks like under current law. Here's what debt would look like under the current president's budget proposal for 2022. If it's fully enacted, it would raise the debt pretty significantly, but give you some idea of what sort of numbers that we're talking about under proposed spending. So that's a brief talk about financing government. Thank you.